Welcome to the Dividend Talk podcast, episode 208. The last bit of earnings and NN Group did it again. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom and I'm joined with my co-host European DGI. If you want to learn more about us, please visit europeandgi.com where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Yo, European DJI. I went back old school with my introductions. How are you, my friend?
Hey, Mr. Yeah, really good. I just came back from another vacation at the Policy site here. So it was really great weather. But I must confess, I'm tired of traveling. And I just don't want it anymore. I've got a lot of business trips coming up for work. So it's not going to make it easier. I'm so tired of traveling, but it was awesome. It's, perfect weather, 24, 25 degrees, nice sun, good beach. What do you want more? Some nice fish to eat. Life is good.
Yeah. What's so funny? I'm looking at you and you're back from your vacation. You look nice and refreshed and energized, and like what a vacation is supposed to do. Well, I'm just back also, and I feel like crap. Jet lag is horrendous. It's something I never really suffered with before, but as you get older, I suppose it gets your body takes longer to adjust.
Yeah, but you went to Vegas, and I've seen the Hangover movie, all of them. So I know what you've been doing there. Did you find any tiger in the kitchen or baby under the sink?
Nothing that outrageous, but you see some pretty wild stuff over there. Lots of people dressed up in all sorts of costumes walking down the street. It's a strange place, but it's epic. It was epic. It was a great holiday. You'd be happy to know I didn't gamble away all my dividends. I was very conservative that way. And
that's good. But tell me, how's Vici doing?
Vici's doing well. The place is packed. Every hotel is packed. You could see the allure of it. But the only issue I had was the price of everything was crazy. And I mean, for simple things, food, drink, clothes, you obviously have your spots where it's reasonable. You have to go looking for them. But in the main places, it's so expensive that you just wonder. They're now starting to milk you, because I went 10 years ago, and it was expensive, but I didn't get the sense that they were trying to milk you out of everything. There were still kind of deals, but now it just feels like they're just trying to milk everything.
What do you pay for beer?
Oh, beer is so. If you're gambling, it's free, right? But if you don't, you could pay $20-$25 for beer, easy.
But how do they know that you're gambling? When you're sitting behind the slot machine, that's when you can buy a beer or take a beer?
Yeah, sitting behind the slot machine or sitting on the poker table or a blackjack table, and they'll come over, just have to tip the waitress. But if you go up to a bar, if you walk up to the bar, for example, it's expensive. So I bought 2 Baileys, one for me and my wife, and it was $60 for 2 Baileys. They're tiny.
But should we then be concerned, or should shareholders be concerned when there are such prices? Because on the other end, you said it's packed. I mean, if there is an oversupply of people that want to gamble, then you got price elasticity, so you can just raise the prices until the people stop coming, right?
Exactly, and I wonder what point will be the breaking point for people to stop going, because it's getting out of hand, I would say.
For the immediate moment, I wouldn't be concerned. It looked like there was plenty of people with plenty of money to throw around. But if prices continue, the ordinary certainly I would not go back again. I'd rather spend my money doing something else. To get me.
Yeah, but for me, it's the same, right? Traveling through Europe this summer again, also on the policy side, prices are much higher than they used to be, but that's just a result of inflation as I see it. And it does feel expensive because we are price anchored also to the prices still from 2 years ago. To see everything 20% more, it feels really different, right? So I also think there's a part of psychology to it at the same time. Yeah, but it's everywhere, inflation. I think that's also why we see at the moment in all the earnings reports all the time weakening consumers, right, for the stocks that we analyze, except for those few that are seemingly having a product where they can price still much more. But most companies just have a weaker consumer at the moment in China as well. So I think, I don't know if that's also what you experienced in Vegas when you talk about those prices, but I experienced the same as well on holiday, that it gets a bit frustrating because you indeed feel like you're milked out everywhere. And that's not a nice feeling when you try to enjoy. But again, I really wonder how much is it like the business owner really milking us out versus like that's just what it costs nowadays and we're just price anchored.
Yeah, I'll give you one example quickly and then we'll move on. So I understand the inflation part and there's some bits that deserve to go up in price.
Yeah.
But for example, a daybed, so renting a daybed, they had none there that you could lie on. You had to rent them. 10 years ago, I stayed in the exact same hotel. There was loads of them around the pool, around the area that you can lie on. To rent one of them was $150 just for one of them. It's crazy. And then what they've done is they reduced the amount of them. So there wasn't that many and put up these cabanas instead. To rent the cabana was $450. Plus, you have to spend an additional $180 on food and drinks. So that's what I'm saying. Like those things is not inflation based. That's a choice by them trying to milk as much money out of you, either to get you away from the pool into the casino, or just to extract as much money as possible out of you.
So as a European, I guess you went to the local store and you bought a towel and you were just lying there, right, for free?
No, I didn't buy a towel. I got a towel from my room. And put it there, and then sat on that, and then got a new towel every morning. It was
that's what we Europeans do. Come on, they can't screw us. We just take a towel, and then they saw your white legs. They probably didn't see the difference between you and the towel either.
Yeah. So look, enough about Vegas. It was fun time. Definitely worth seeing if you haven't seen it before, but bringing a lot of money.
And then have you been to Starbucks there then?
There was Starbucks everywhere.
And were they packed?
Yes. In my hotel, there was at least 3 in my hotel. I stayed in Planet Hollywood. And every single place I went to, there was 1 or 2 Starbucks. It was everywhere over there.
That's really good. So the former CEO, because that's why I'm making this little bridge, so he was able to communicate the value about the coffee.
Yeah, I'd say so. Because, that's 2 places I've been, Spain and Vegas, where Starbucks has been. I don't see it in Ireland as much, right? But we're smaller here. But it was.
I'm saying here because the guy got sacked, right? Lexman, the former Reckitt Benckiser CEO, he got sacked because he had this epic interview with Jim Craner after the first quarterly earnings, where he was saying like, we didn't communicate the value well enough to our customers. It's effing coffee. So he clearly was like a clown there on this interview. He knew nothing about what he was talking about. You could see he's kind of having a consultant background, lots of words, no content. And I was also I was tipped by someone to listen to the Acquired podcast with Howard Schultz. So when I came back from my holiday destination 2 weeks ago, I was listening to it for 3-4 hours. And it was really great to hear Howard Schultz talking about, for instance, how the app the Starbucks has is not a good thing in his opinion, because for him the Starbucks experience was always about the community feeling, being there, having a business meeting, sitting there, discussing stuff over a coffee. And with the app experience, you're taking the experience outside of the shop, because people just order via app and pick it up. But you then compete with all the other coffee chains really easier, where you don't have your uniqueness. So it was really interesting to hear him talking. And now they hired the Chipotle CEO for a package listen of 113 million. I saw quite some outrage also on actually not on FinTwit, but outside of FinTwit about this pay package. But what people don't understand is that 75 million of this is just buying him out, because he held a lot of Chipotle shares and worth of around that. So Starbucks is just buying him out effectively, and you can't have, I said, a conflict of interest, right? If he still holds 75 million of Chipotle shares. So this will be transferred to Starbucks shares, as far as I understand. The other one is the guy earns 1.3 million in salary, and then I think up to 23 million or something like that in bonus potential. And I think if he can turn around the company, that's quite fair for one of the top 100 companies in the world, right? Here. So very interesting. I think he did like an 8-fold of this Chipotle stock over his tenure, maybe even a 10-fold. He clearly has done a successful job there for the investors. So I hope he gets kind of what Schultz was talking about and focuses on the underlying strength of the company, and not like what we saw with Kevin Johnson, I think was his name before, and now this Lexman, that they are just thinking about either financial engineering, what Kevin Johnson was doing with buybacks. Because I'm also of the philosophy, business first and earnings will come.
Yeah.
You of course need to do proper accounting as well, but first the underlying part of the business. And I think it wouldn't take a lot to restore Starbucks growth, and even it's not even doing so bad.
Yeah, it'd be interesting to see how he gets on. Obviously, Laxman came in from the UK.
Yeah.
We know how Europeans and Americans kind of different philosophies and
Yeah.
how we think. So it might be actually good to have a more US based. Obviously, he doesn't have to relocate.
Yeah.
Laxman did. He had to get used
Yeah.
to the culture.
But come on, even you get used to as much as you want to the coach, but if you say that we didn't communicate the value well enough to our customers, when you're talking just about a latte and a cappuccino and such, I mean, sorry, that's not going to solve your problem. For me, this is like what you see in companies, like they deliver an internal product and then it's not working well enough, and then they think that the communications teams is going to solve it.
Yeah.
And then spend millions on that instead of just fixing the bloody product or just stopping the whole development.
Yeah, we'll see. So, but as a Starbucks shareholder, you're happy, right?
I'm happy with him coming in as a CEO because his track record sets expectations. Let's say it like that. And we can't ignore the thing that he did with Chipotle, also knowing that they came out of, the food hygiene crisis. But, I'm not happy that the share price popped already, because I was kind of dollar cost averaging into the stock. At least I was able to build up a relatively decent position already, but I wanted to still buy more. But it is like it is. Maybe we'll get an opportunity again. Maybe he works on a kitchen sink quarter somewhere soon coming up. That would be really awesome. But look, hey, more on the front there, because also Nike, right? Another stock that was kind of struggling in sales. And here the news is that Bill Ackman has bought like 3 million of shares with Pershing Square. So also very interesting. Clearly, I'm not the only one that was seeing value in Nike here. And also the share price started to recover there. With shares, with Nike, I just initiated the position like several weeks ago. Really curious to see, because Bill Ackman is a bit of a hit and miss guy, in my opinion. Very clever guy, but not necessarily always making the right bets. So we'll see. So what do you think about that one?
Yeah, I wouldn't just buy blindly because a billionaire Bill Ackman buys
No, of course not.
3 million shares. But yeah, I mean, there is the value there. We spoke about a weakening consumer. That hasn't changed yet. China is a big part of Nike as well. And we've seen all throughout this earnings that China has heavily influenced a lot of the earnings of our companies. So we need to see a little bit of a turnaround there. But yeah, it's like Nike is just one of those ones. It's a strong brand. You can see the appeal. Bill is looking at him like us, going, they're down under $100. That's probably where I want to own them. So nice one from him. But let's forget about our US compatriots for a moment and focus on one of our European companies we've spoke about so many times, and that is Bayer. They've actually been successful in the US with a litigation case, and their share price has popped as a result.
Yeah, so what is really interesting about this litigation case is because a Philadelphia appeals court concluded that the federal regulations governing the pesticides warning labels supersede Pennsylvania's laws, under which a Roundup user in the state claimed that they should have warned them about the cancer risks. This is very interesting because it's taking it to the federal level and effectively making the state's verdict obsolete. And the thing that what Bayer has been always claiming is like, guys, follow the science. There's no such evidence as what you all claim. And guys, it's been approved. Yeah. So it's not like we've been fooling. That's kind of, in a nutshell, how I always read their comments, right? So, and here effectively a state has been overruled, which is good for Bayer. And of course, there's always this sentiment towards the patient, right? Here. But it's good for Bayer. And then, of course, Forever Learner asked, like, is it now attractive that the legal trouble seems to be getting better? I mean, there are so many court cases going everywhere around. For me, one swallow doesn't make a summer yet. So I think it's trading where it's supposed to trade. If it gets the legal cases behind, this share price could easily double or triple. But this is really for the thrill-seeking turnaround investors. This is not something that we should have, I believe, in a dividend growth portfolio.
This was a single case victory, and it popped 11%. So you can imagine that if they can eventually turn the tide and get rid of this litigation, you could see the share price soaring back up to the highs it once was, up around 100 euro or so. But like you said, one case doesn't make it a winner overall. We know how complex the US system is over there. As Europeans, we probably struggle to understand it fully. So I would not be rushing in to buy them just yet, unless, as you said, you're a thrill-seeking turnaround play investor, which I feel like we were before, but I'm staying away from turnarounds.
But this falls into the category of the people that are interested in investing in medical property trust. Add Bayer to it, add Intel to it, and good luck.
And let's finish off recent dividend hikes, and there's only been one that we can note, and it is, you can't borrow conviction, remember, but it's NN Group. They hiked their interim dividend by 14%, from €1.12 to €1.28.
Yeah, this is amazing. Yeah, we all know that this is a 7+% yielding company with a proper track record of dividend growth since the spin-off from ING. So it's been amazing. I mean, Leven van Dividend already predicted this because they have the tendency to pay out 40% of the as an interim from the former final dividend. So this is exactly 128. But I mean, I'll take it. It's a really nice dividend, really juicy. I'm really happy with my shares here. And maybe there's also a nice bridge to the main topic of today, and that's some of the earnings. And this dividend news came together with the earnings. And what's interesting, that we got some questions like on social media, like, okay, so if this happened, why is the shares down? Honestly, I can't give you a clear answer to that particular statement, because sometimes I don't just understand the market. We later also have a question about the market efficiency, let's say. But look, really simply said, they generated, I said operating capital, OCG, that's what they track themselves with, of almost $1 billion in the first half of 2024, and they are on track for their target of 1.9 billion in 2025. Yeah. So I think what people need to realize is that as per my understanding, the dividend that they pay out annually is around 500 million. Yeah, so there's enough coverage of the dividends. So no surprise that the dividend is also growing with more than 10%. The solvency ratio, so that's kind of also the, let's say when you think about solvency ratio, you can say here also like what's their coverage of their obligations? Is it 192%? It was 197% before, declined a little bit. No meaningful big reasons of why. It is just far above what investors typically look at. It's like 150. Then the dividend is really unsafe. 170. People start to wonder about the dividend safety, specifically if the trend is down. So this is really nicely above their own KPIs as well. Free cash flow is up, so they committed again to progressive dividend policy and another part of the share buyback of at least 300. So in my opinion, this looks all good. It's just cash rich. What is also nice is that the combined ratio of the non-life business was 92.2%. So also again, a good coverage of their underwriting and such as well. Europe continues to grow, also Central and Eastern Europe. I'm not surprised with that, seeing Czech Republic and Poland doing well, because I live here and I see how it all is going. So yeah, just solid numbers. They're on track onto delivering what I guess the general expectations are. And they also announced that they will have Capital Markets Day in May next year. So it will be really interesting to see what they're coming up with long term. But the solid performance and yeah, a huge dividend hike, right? I'm curious if the final dividend will also see double dividend growth. At least the buybacks will contribute to some of what we can expect. And yeah, you still get the shares at about 7% yield. So not too bad, right?
Oh.
And this week, the upcoming week, we have ASR announcing their numbers. So I'm very curious to compare the both of them as well.
Yeah, it's one of those companies that's in the sweet spot of high growth and high dividend yield. Obviously, it won't last forever.
Yeah, so in other words, a very low valuation.
Yeah.
When you think about the multiple, otherwise you couldn't make up these numbers.
Exactly. But look, strong results. The share price drop, I don't know, is it that to do with the solvency ratio? I know it dropped 5%. I can't see much else why it would drop unless there was something in some Dutch news that
you can look it up further in the report. There are some, but I mean nothing meaningful in my opinion.
Yeah, quite interesting. Nice one. I'm happy with the double.
Do you own some NN Group?
Yeah, I own quite a bit. So quite happy with that one. I looked at John Deere. Everyone knows John Deere, the tractor company. I actually grew up thinking they were an Irish company because we have them everywhere, and every single farmer I ever spoke to over here spoke about John Deere. So cue my surprise when I found out they were not actually an Irish company; they were an American company, which is quite funny. But it's one of those companies that in their industry, their name is kind of always at the top based on quality and everything. But it is a heavily saturated market. You got the likes of Caterpillar there, and there's other companies that are not even public that are quite strong. I think what you need to know about John Deere is that they are transforming into this agri-tech kind of company. As you know, tractors can only get you so far, but farming is a dying trade. You need technology to help these guys out. So I think there's a lot of tailwinds there for the company. But as everything, they were severely overvalued. Over the last couple of years, they had their sales jumped up through the roof, particularly over COVID, and it was always expected to see a pullback. So we're starting to see that now. We're starting to see a bit of a weaker consumer, even in agriculture. Sales and volumes have both dropped heavily. 17 to 20% is what we're looking at, which is quite significant. Net income obviously follows suit with all of that. On top of that, They are balance sheet is kind of, it's not the strongest, I would say. It has quite a lot of depth on the balance sheet. You're looking at 2.91 debt to equity. So that's always been a concern of mine, particularly when you start to see sales dropping and interest rates kind of going up as well. So it can kind of have a burden on it. They can well cover. Interest coverage is up around 5 or 6. It's on the low side, I would say. But they can still manage that. So I would say this is a good company, but at the moment we're in a bit of a cycle. It's a cyclical natured business. They were always they're at the top of the cycle, so I'm expecting this actually to drop over the next 2 or 3 years, and they might come into some value range. So I'm not surprised to see a drop in this in terms of
What's really
sales.
interesting that year to date, the share did nothing. Yeah,
Yeah,
to date, it's
yeah.
like flat, and actually after the earnings, it even popped a little. It popped a little bit. Yeah, so really interesting. You would expect that this. You see these numbers also compared to last year, even the first 9 months compared to last year, like 11% sales down and 25% net income down. You would expect not that the company then starts trading sidewards. You would expect that it goes down quite significantly.
Yeah,
And
yeah.
it didn't, and it had been trading sidewards since 2021. Actually, it's been kind of dead money, but its valuation is needed now running into it. It is actually even tanking at the moment, right?
Yeah,
The underlying earnings.
It's mad. It did drop about $50, so it was trading at 385 just before, and it dropped it briefly to about 344, but it's back up around 380. I'm really surprised at that. Looking at the numbers here, looking at how weak the rest of the year outlook is going to be, like they're not expecting us to have a strong second half of the year, expecting it to be just as weak, and the share price just did not follow what we're reading. So I find that very, very strange. But I'm expecting another year or two of this, if I'm honest with you. And then I'm hoping it comes into some sort of fair valuation, because it is one of those companies that you'd like to own based on their brand power in that industry. But converting themselves to agri-tech is going to be a challenge, particularly when you have the likes of Caterpillar. Siemens can enter that group, and other companies are all trying to vie for the same space. But yeah, look, it was a very, very, very weak quarter from them. And
on the other end, you can still say that the company is trading at kind of a 13 multiple, 1.3, which is not like 20 PE at the moment, right? But of course, if you then look at the yield of 1.6%, you just know that they have they pay a very low dividend.
Yeah, they have their dividend payout ratio is 25 to 35%. They're well in that. I think the last time I'd done this, it was around 17-18%. So they still had some even room to grow into that low dividend. So it's quite a conservative policy.
Yeah,
but they make it work.
Good, very interesting one. It's one of those companies I would like to own one time. Simply said.
Yeah, me too. And when valuation comes into focus, and actually, I kind of briefly saw that they not dropped, that the sales was weak. So that's why I was interested to see where they were, but I was surprised to see the share price not following. So market efficiency. We have another question on that, so we'll get to that.
Yeah, exactly. Hey, then maybe switch to Germany then. Let's go to Henkel. We actually don't really discuss that stock here, but Henkel has a dividend history. Over the last few years, they kept the dividend flat, also this year again. But, they start to recover bit by bit, at least in terms of share price since the bottom in 2022. It's now at 78 euros, 2.37 yield. So I looked into their key financials, and what surprised me was that also here the earnings were really up while sales were flat. And I felt like, how the hell do they do this? Yeah. And when I dove into the numbers, what I can tell you effectively is that they saved almost $1 billion compared to last year, let's say, in their cost of sales. Yeah, so that's really what has been driving the profit up. So they do claim a 2.9% organic sales growth. Yeah, 4.3% in consumer brands and 2% in the adhesive technologies. But overall, a 1% decline in sales, of course, for adjusting of business units and such. They also claim to have a adjusted earnings per share of 2.78, but I'll prefer to go with the accounting standards, so 2.46, which is really a huge increase therefore. And what I find so interesting is that when things go up in the positive way, they don't necessarily say like, oh, we had a one-off here, right? But this is where the financial statements don't lie, because if you then go into the cash flow statement, you see all this being added back again. So it was really a result of working capital management, which is also impacted by cost of sales. And then if you look at the free cash flow situation, it's effectively having a flat free cash flow compared to last year. And the dividend isn't even so nicely necessarily covered then as what the net income does suggest. So this is also where I think like, yeah, okay, Henkel, like, if you don't put in your top line numbers that you've been kind of just fooling around here, and that you fooling around, let's say, and I need to read it in the free cash flow or in the cash flow statement. That's a big, for me already, a big, that's called the orange flag. And that's exactly what Henkel is showing me. They're claiming like lots of great numbers with that. Also, they've updated their guidance that their return on sales will be a bit higher with a few points. Also, their EPS will be much higher on constant currency exchange rates. But again, if you fool around like that, I want to see that this cost of sales change has been very sustainable. If you're able to reduce your cost of sales by almost 20% year over year, then I want to see it sustainable and not like a one-off because I don't know, you're doing some of your inventory or something like that, or with your payables. So that's my key observation on Henkel. Now, also for people that are further interested, like, look, it has an A2 credit rating, which is good. But what people may not know, 14 billion out of the 33 billion balance sheet is goodwill. I must say that 20.5 billion is in equity, only 2.5 billion in borrowings, long-term debt. So debt-wise, very well capitalized, but there's this big goodwill behind it. And goodwill in itself is not bad, here, because it's effectively what they overpriced when they were acquiring businesses. But companies can grow into it, so that's generally okay, as long as that's the case. So for now it's good. So that was my quick take on Henkel. That's on the earnings. It's not a company I like to follow a lot, and again, that gets confirmed now when I look into these numbers, and I have to go into the cash flow statement to see that everything comes together there.
Nice one. Yeah, no, it is a company that we don't speak about. They have a solid dividend history as well.
I think the last 4 or 5 years have been flat, and that's a good thing from that point of view, that they've not been reducing the dividend. They kept it flat over those years. But I mean, there's nothing sexy about this company either, in my opinion. So I'm curious to hear from our listeners that may be invested in Henkel, what the bull case is for them. But I don't really see a strong one.
Cool. So the last company then I looked at is Home Depot, ticker symbol HD, and it's kind of been a flat-ish year for them all around. Sales is up by 6%. Operating income is down 0.8%. That is due to higher selling and general administration costs. There were some higher interest rates, which affected our loans. So that brought net earnings down by about 2.1%. And the CEO commented on that as well, higher interest rates. He did mention a weakening consumer, leading to lower volumes and sales all around. They've also added quite a bit of debt to their balance sheet due to their recent acquisition of SRS Distribution. And this company trades for professional roofers, landscapers, and pool contractors, which I assume you need in the US, not so much here over in Ireland. So look, that added a bit of goodwill and a lot of depth to their balance sheet. Again, their sales, they're expecting it to be down over a 52-week period. We do have 50. This is something we need to keep an eye on, is this 53-week period this year. A lot of companies, some companies will tell you, some people will try and hide their numbers within that. So it's interesting that they give us a forward outlook based on both. They expect it up over 53 weeks, but down over 52 weeks. They've opened 12 new stores. And yeah, that's pretty much what they're expecting. Pretty much 2 to 3% growth over a 53-week period. So look, quite fat for them. The acquisition was the big news, I suppose, from them this quarter. I'm not too sure. I don't know much about SRS distribution, but they paid a lot of money for it, so they seem to have a lot of conviction in that company. So yeah, it's a hard space. Obviously, you have Lowe's who are in that space as well. But Home Depot has more scale. It's one of those companies that is just massive. It's everywhere. The scale to adjust, and if they're seeing a weak consumer, you can be pretty damn sure the likes of Lowe's and the rest of them are seeing it as well. So interesting to see. But they're targeting more professionals. Let's see if that construction space is going to start picking up over the next 12 months. But there's no indication that there is.
Really, really nice. And I just did a deep dive not too long on Hornbach as well, right? Which is kind of, well, maybe not in size, for sure not, but in the similar business of do-it-yourself. And I was just trying to look up the sales per square meter, because I saw that they made like $600 per sales per square meter. And I forgot what was in Hornbach. But I think if you would annualize that, you may come to the same number. I know that Hornbach has a really high sales per square meter compared to its competition.
Yeah.
I just don't find it so quickly, so I'll look that up after the show. But yeah, interesting. I mean, Home Depot, we spoke about it a few times. It's I think it's a strength. It's a sign of strength that their earnings are flat in a difficult situation.
Yes, I think so. I think so. They have economies of scale, don't they? They're far larger than Lowe's. Like Lowe's is next best, and I think they're 3 times as small as Home Depot. So they've got size and scale on their size. But the fact that you're right, the fact that they can keep everything flat while struggling, a struggling consumer environment is a testament to management there. And I think another one of the 2 of these quarters, and they'll start getting a little bit more interesting. They trade at 2 point. Let me check. 2.5, 2.5% dividend yield. So they'll start getting interesting, I think, if we have another quarter or 2 of this.
Nice. Okay, I think that, by the way, I found it. Hornbach in 2023 did 2,823 euros in sales per square meter. So, and there, Home Depot did $660 in sales per square meter, so like 600 euros. So if you would annualize that, that's probably like 2.4 thousand. So maybe with Christmas season a bit higher, but it's really interesting that you can compare this with the the German Hornbach. Really interesting, right? For me, this is like a very interesting statistic.
Just remember that US is feet, not meters. So
we're talking about feet here. Okay, then never mind. Then never mind. Okay, let's not cut this out. It shows my stupidity. But I rest my case. Just for the European investors, Hornbach has the most sales per square meter in Europe.
Just divide it by 3.2 thereabouts, and you'll get the same value.
Yeah.
Anyway, let's move on to the portfolio review, and we got one from Kieran Ainsley in this week, and there's a couple of questions in there as well. So he has BP versus Shell. Is BP currently being discounted for a valid reason compared to Shell? Businesses run a bit different. Both are based on energy, but obviously BP is UK listed stock, but so is Shell. So I'm not sure the difference is there. But Shell is near its 52-week highs. BP is around the middle. The yield is an extra 1% with BP. So why are they different? I suppose is part of these questions. And he's also patched his portfolio, and I'll just call out his top stocks. So he's got Ahold Delhaize at 11%, Realty Income 10%, Vanguard All World ETF 10%, Johnson Johnson 10%, and Starbucks 10% as well. There's his top 5. So what do you make? What do you make of Shell versus BP, and what do you make of his portfolio?
Shell versus BP is quality and reliability. Shell has shown just more quality and reliability as a company over the last decades. I think investors still know Deep Horizon. Investors also know the dividend cuts. I think this is holding BP down in generally. And I think Shell is more attractive, therefore, also to the international investor. What is good to say that BP has a much better reserve life. So it has still more, let's say, ability to generate cash flow, while Shell may need to invest more capex to replenish its reserves. But I think just it's a perception of quality that's different, Derek or Kieran. That's all I can make out of it.
Good.
And then when I look at this portfolio, the top 5 of Ahold, Realty Income, Johnson Johnson, Starbucks, I just see quality there. Also the Vanguard All World index, I just see quality here. That's just it. It's a really, what I also like to some extent is that this is a very concentrated portfolio. So I assume he's still in the start of the accumulation phase, or he may be already further down the road, but I still assume, but it shows a lot of conviction when you're having this kind of concentration of having 50% in 5 stocks. But it's something that I don't have. I get nervous about that. But we do know that concentration in high quality, and if you pick the right stocks, you will definitely outperform the more diverse portfolio like I have.
Yeah, it's a very safe portfolio. You've got a lot of consumer staples, and they are even past what we said. We've got PepsiCo, we've got McDonald's.
Yeah.
Then obviously you've got Starbucks. You've got Realty Income, which is the monthly dividend king. But one that stuck out that we don't often hear about is Wynn Resorts. Obviously based in Las Vegas. The owner of that is a billionaire, built 2 brilliant hotels there. I actually wanted to go play golf there this weekend when I was there, but they were charging $500 for a game of golf. Now, I'm not that good at golf, so I was like, no, I think I'll pass on that one. But it's an interesting one. It's a low yielder, 1.31%. Not too sure what the growth is like. I haven't looked into them, but it's certainly an interesting one. I always wonder why go with Wynn Resorts when you can go with BG or maybe pick a product. They own 2 or 3 hotels there. But yeah, it's definitely a very, very strong portfolio, I would say.
Yeah, and another thing that I may be missing here a little bit is technology. I think if you look at how the world is evolving and the role technology plays, I think if you want to have a portfolio that's also, let's say, they're really in a good situation 10, 20 years from now. I mean, of course, with consumer staples, you're often doing well. Yeah, but I do think that, and this may be a question to Kieran, that some technology may be interesting. And it's difficult to have technology because everything seems so overvalued there. But that's the one thing that also stands out in this portfolio that I'm kind of missing in here.
Yeah, but the All World ETF kind of covers a lot as well. So you're kind of well diversified within that.
True, but look, people submit their portfolios probably not only to hear what they know, but to get inspired by us, right? So that's one of the reasons why I'm sharing this.
Yeah, good.
So it's not a judgment whether the portfolio is good or bad. It's more like an observation here.
Yeah. Okay, so listeners' questions. We have quite a few to get through, so we'll see how many we can do. We'll do as many.
Let's try it quick.
Yeah, every time we say that, it doesn't work, but let's try.
Yeah, but otherwise it's for sure slow.
Manny Mystery has asked us, not sure when you're going to make the next podcast, but he has a question. I would be interested to know what each of you think about market efficiency. Do you think the market is efficient or not, and why?
This is the good old discussion, right? Which we also had with our professor. And of course, a professor as an economist, they believe the market is efficient. Over the last 10 years of investing, I believe the market is not efficient. It makes no sense to me to see sometimes companies that are clearly undervalued. So yeah, and also it suggests that there's always a rational decision behind it and that the news kind of covers it. But honestly, if you look at the amount of index investing that is happening, are all those index investors like Kieran that are putting money in the all world index? Are they really contributing to an efficient market? Nah, come on. They're not investing in the holdings of that ETF based on analysis of those holdings and using the news to influence their investment decision. No, they're just buying all basket of stocks, no matter the price at that moment in time, but just that they're part of the ETF. Yeah, so if you also look at that from that point of view, I think it's even just getting less and less efficient, because we see that as well. Sometimes it's surprising that companies don't get punished, where in the past you would have seen them being punished more. Yeah, it's more like what are driving markets nowadays are rotations. Yeah, people feeling like, oh, I need to now move out of a technology ETF into a consumer staple ETF because the economy is changing now. We're going to come into a recession. Yeah, so yeah, no, that's my thinking. I don't think market. I think market. When you zoom out, you could argue that the market is efficient, but when I go to individual stocks, I don't think so.
Yeah, that statement I would agree with. I think if you zoom out on an individual stock basis, there's too many. There's too many for it to be efficient all of the time, and then we would never have overvalued, undervalued. Everything would just be fairly valued, which is not the case. But yeah, I think we gave some examples up above. John Deere, for example, sales dropped 20%, price flat. I mean, it doesn't make any sense. How can they?
Yeah, but suggest that the market knows something that you don't know.
Yeah, that sales are still going to be down 20% year on year, and I'm happy to pay extra for it. I don't know. But
so a bloke somewhere in Ireland in a little room with a microphone has a better view than the market.
Yes, I would say so.
By the way, I agree. Right, from Polish location point of view.
Philip has asked us, how do you recognize sector cycles, and do you make use of them to increase your holdings in certain companies, or do you invest regarding of cycles in those companies?
So how do you recognize sector cycles? I think we just see it by reading the reports. So what is interesting is, like, you can read, for instance, in reports that companies are really very obvious investing in AI. Yeah, so you see all these kinds of things, and that's where we typically see whether something's going bad or something's improving. Do I invest regardless of cycles in the companies? Yes. I really look at, is the dividend yield good? Is the dividend safe? Can it grow? Is the payout ratio good? And then it's a consideration for me. Often when you look at those few items, then you will find, if it's interesting there, that probably the value is also based on discounted cash flow and everything fairly valued. But what I do find myself is buying then often similar companies in the same sector. We saw real estate last year and insurance companies last year. So it was clear that the sector was in a cycle, yeah, and it's starting to recover now a little bit. But I don't use the cycle as a lead to invest. But often I find myself investing in a certain sector because of the cycle.
Yeah, and some sectors are easier to spot than others.
Yeah.
Say energy is one that's probably easier to spot when it's at the lower end of the cycle, whereas consumer staples, because it's so broad and you've got so many different types of consumer staples, it's hard to say that whole sector is in a cycle. Like, for example, we have Nike that is down at the moment, but we don't have maybe a whole, but you don't have every consumer staple, so maybe more industry specific within that sector as well. So.
Yeah, and technology is also really hard to grasp because there's so much high growth in technology. Then if it's slower growing, are we then talking about a cycle? Yeah, I think that's as an example, a sector where there's really like a secular growth trend going on that is kind of breaking maybe traditional cycles.
Centrino, during the last red days, did you invest more than during normal months and even use your emergency fund?
No. How about you?
No, I did not. I kept a little bit aside this month because I was going to Vegas, but it means I have extra because I didn't spend it. I knew I wouldn't spend it, but I wanted to have it just in case. The last thing you want is to be away and not have the funds there. So I kept some, but I have a bit to invest now this month.
Nice.
Brecht has asked us, what are the most interesting and relevant metrics to track the performance of your dividend growth portfolio? I think of projected annual dividend income and yield on costs, but they don't give you the full picture.
Yeah, what I really look at is organic dividend growth. Yeah, so historical. So year over year, has your portfolio been organically growing its dividend by a certain percentage, which you also plot in when you're forecasting your, let's say, financial independence date? I know that not many people track that, but that's very important for me because I use those assumptions for my prognosis of when I can retire early. Yeah, and so that's actually one that I would add here.
Basic Investor ACC, weekly listener to the podcast. Thank you. Just curious what you think of my investment strategy. 22 years of age, 20% in low-cost index funds, 30% in dividend growth stocks, and 50% pure growth stocks, anticipating on future dividends.
I really, I'm sorry to say, but I really can't say because I don't understand. I don't know his context. For instance, for me, the most important thing to know is like basic investor. What are you? Why are you investing? What are you trying to achieve? Yeah, because if you're, for instance, living in the Netherlands and you have a wealth tax and you think like, well, I'm just trying to get to a 1 million euro portfolio size, then this could be a really nice way of doing that. But if you're saying like, no, I want, I don't know, 50K in passive income in 12 years from now, well, then this setup may not be good enough. Yeah, so it's really hard to say. But generally speaking, when people say that they have almost 50% in pure growth stocks, and when you're 22-year-old, the general wisdom is that you can better take such risk when you're younger, so to have higher beta and everything. But it's for me really hard to say anything meaningful if I don't know the context.
Yeah, I agree. But if you were just to make assumptions, 22 years of age, that split is probably fine. You can take a bit more risks going with these pure growth stocks, is what I would say. But European DJI is right. Without context of your goals, it doesn't mean much. So yeah. Javier has asked us. He's currently based in Malta. If he was to move to another European country, what should he consider other than different tax legislation?
Well, Alexander on Facebook answered the weather. Because that will only get worse from there. I think that's important. I think the language, the job markets,
food, culture,
accessibility to stocks as well in some areas. I mean, there's so much, Javier. I think when you're based in Malta and you're enjoying it there, and your investments, your let's say your ability to save and invest will meet your goals, then I would rather say like stay there, please. Yeah. It's not like it's getting better up north. Yeah.
No. I couldn't agree more. Brian, I realize the folly of trying to time the market, but how do you think about waiting for stocks that are fairly valued versus timing the market? What would you say is the difference between those two things?
Well, the biggest difference for me is that we still dollar cost average into our portfolio. And I think that's the main difference that people maybe sometimes confused by, because we do wait for certain stocks to be fairly valued here. But of course, there is some aspect of timing the market into that. But we look at it a bit different. Like there are always 5 stocks in the entire globe, let's say US and Europe, that will show some kind of fair valuation that you can dollar cost average into. So why worry about those that are highly overvalued? Yeah, but yeah, you can also just dollar cost average into other stocks that feel expensive. Let's take Novo Nordisk. You can dollar cost average into that now. But what is your time horizon of dollar cost averaging? If it's 1 year, you may be still timing the market in the top of that year, while if you spread it out over 5 years, so it isn't that black white, I would say. If you're really talking about pure dollar cost averaging, you will buy, let's say, the S&P 500 index, only buy every month something, and then I think we are talking about the purity of dollar cost averaging and not timing the market. It's a very interesting question from Brian, because when you are kind of using our approach, there's a little bit of timing the market to that when you are value investing. To some, I mean, you could put that relation, I would say.
Yeah, you're timing the market on an individual stock, but you haven't stopped investing. So you're still investing your money. You're still applying your cash. It's just you're waiting on an individual stock before you start investing in them again. Whereas I feel timing the market is that you're holding all your cash back and you're not investing.
Exactly.
And you're
exactly.
Well
that's said.
The difference. Manny Mystery put up a post on Facebook about Coca-Cola. And he's asking, is anyone keeping a close eye on Coca-Cola, because their decade-long fight with the IRS could end up with Coca-Cola owing about 16 billion in backdated taxes. If they lose the appeal, the share price looks likely to drop significantly, as you would expect. However, I think the market will price in a higher average annual tax burden equating to 16 billion, but approximately 10 billion of that is interest charged by the IRS. And so only 6 billion would have to be apportioned as an average tax burden per year, not 16 billion. And he sees that this could present a buying opportunity if they tank as much as they're expecting. Any thoughts on this? Have you been watching this?
No, but I do think this may help a little bit if you want to buy a dip in Coca-Cola and such. But let's not forget their free cash flow has still been 9 billion over the last trailing 12 months. This would be a one-off. Plus, after that, a little bit of a higher tax burden to the company. So I don't think it will really put the company under pressure long term, but I'm with him. Short term, it may definitely give investors a better opportunity to buy some. Yeah, so it will have to come from the balance sheet. It is a credit rating A1, which is quite good. Remember, 62 years of dividend growth. It does have a relatively high payout ratio of around 80 to 90%. So, but I think they will just leverage up for this, and if needed.
I agree, by the way. Hugo, you are forced to sell one of your top 5 holdings. It's mandatory. You've no other option. Which would you sell and why?
ExxonMobil, without a doubt.
And why?
Oh, why? Because I don't have the same strong conviction that ExxonMobil will be doing me well 15, 20 years down the line from now. I have Shell as my biggest position. Why Shell? And that's interesting, right? Because ExxonMobil has shown more stability over the years than Shell. Shell has clearly been struggling to find its way, but I have a feeling that Shell is doing stuff and learning about the energy transition, and this is still where the long-term risk is for oil and gas companies. But maybe I'm just seeing it wrong. ExxonMobil maybe just like once someone figured it out, they will just buy it. Why worry? So but ExxonMobil I have the least conviction of the 5.
I would sell my top 5. I would sell British American Tobacco. It's obviously the biggest risk there at the moment. Again, they're struggling from a weakened consumer, and what's happening in the last earnings is that what we saw is a lot of people are going towards the non-regulated products. I would say almost illegal products, but non-regulated, because they're cheaper. And oftentimes you see that, and that's a tough environment to be in. So there's a lot of risk with British American tobacco, as you'd expect from a 10% yielder in a declining market, I would say. So yeah, British American tobacco, no brainer for me. Fabian has asked us about Agree Realty. He's tried to understand how this exposes him to potential inflationary shock in the future. Do you know what extent the lease contracts are inflation linked? I could not find that quickly. I thought I read it somewhere before, but I could not find it quickly.
So I couldn't find it either. I sent an email to investor relations, but I've not received an answer, so I can't tell you either.
Yeah. I'm almost sure I've read it before, but I don't know where, and I didn't write it down, so I don't know. But checking their reports and stuff yielded nothing for me. But look, Fabian, European DJI has sent an email. Once we find out from them, we will.
Well, I don't expect an answer back if they didn't answer in 3-4 weeks. I don't expect it. I expect an answer back.
Okay. We'll see. If they do, we'll let people know. Daniela has asked us about our thoughts on 4 Imprints Group from the UK. It's a company I didn't really hear of. So many companies in the UK that are growing fast, I would say. But basically, they are a London-based direct marketer of promotional merchandise. So they sell swag, is what they do. And you can see that the revenue has been growing quite quickly. But our concern, and look, we've only looked into this for a couple of minutes before the show, but our concern is around the dividend. Cut it in 2020. I can give them a pass on that. But it looks like it is dropped this year compared to last year. Now, that may just be an interim dividend as well. I'm not 100% sure. But that would be my concern.
Yeah, me too.
So not much more to say about them. As I said, I'm not 100% sure on them. I'm not sure I like swag as a business model either, because consumer trends change quite quickly. But yeah, it looks like they're growing quite fast at the moment. Bas has asked us about a company called Alberts. It's a Dutch company, I believe. So have you heard of them?
Yeah, definitely. I looked also into them a few times. I believe the issue is the lack of dividend stability that they have. But if you look at Alberts, right, and you go to their investor relations website, it's really, really nice how they are writing. So I really advise everyone to have a read of it. It's called the Alberts Playbook. They call it Relentless Pursuit of Excellence. And it's all about free cash flow generation. And it reminds me so much Texas Instruments. If you open up Texas Instruments investor relations, you get it also straight in your face. It's the same with Alberts. So I like the company, but I don't find it to be a stable dividend grower. If you zoom out, though, they grew the dividend from 41 cents in 2013 to €1.13 in 2023, which is an 11% CAGR. But just know that they may cut the dividend along the way when needed. Yeah. So they usually recover quickly from that because the long-term growth of the company is there. It's really a compounder. I think it's a really very interesting company. I just wish that they put some more stability in the dividend. That's only it.
Yeah. Okay. Yoram has asked us about Rubis. They're on the French exchange and ticker symbol RUI. They are expected to increase earnings over the coming years. Their dividend increases of 20 plus years. This includes the financial crisis, the COVID pandemic. Current yield is around 7%, and their valuation PE is around 8. What are your thoughts on this stock, or do you know them?
Well, I have looked into them in the past, and they sound a little bit like Hornbach, but I haven't really looked deep into that. But it piques my attention. Why I'm not researching further, because I've got already Shell, I've got already ExxonMobil. I've got enough in the oil and gas industry, so I'm not really looking to further expand my position there. But so far, from people that have looked into it, I always hear good stuff. So maybe I should look into it for our newsletter service as well, and maybe make a dividend stock card about it to get a bit more of a feeling for it and just analyze it and make up my mind.
Yeah, the numbers that are presented to us there make it look attractive and definitely appealing. So it's definitely worth a look. Thomas has asked us about Bank of Ozarks. They offer decent yield, 3.7%, with a history of fast and steady growth. Would you consider adding them to your portfolio?
No, of course not. It's a bank. It's really like a no-go area. But isn't Ozark also what this series was about on Netflix or something like that?
Yeah,
with this
Ozarks.
family where they went totally bad.
Yeah. It was good. I can't remember her seasons. The last season got ridiculous, but I think the first 2 or 3 were very good, and then it just started going off.
And then wanting to invest in a bank there, it must be a scam.
maybe they own the bank.
maybe they own the bank,
along with the casinos that they bought. Mario has asked us about our thoughts on CME and BMY. So CME Group is a financial services company based in Chicago. They offer some derivatives and anything a good exchange offers. Look, I think they're a good company. Attractively valued? No. There's a lot of, I would say, competition in that as well. And like we're in a fast-changing environment. We look at ETFs, we look at how they involved all these different instruments that investors can, I'm going to say, lose money on now because it's just so many options out there. So I stayed away from them based on valuation, but I can see the attraction to them. I would much rather stick with someone like the London Stock Exchange or something, which gives me a little bit more stability, I would say. But yeah, it's a good company to look into. Dividend yield, I remember, is 2.2%, and they do give special dividends every now and again as well. So I think that's one of the reasons I invested in them in the beginning was their special dividend history. So they do reward their shareholders. But look, there is some risk there. And what about Bristol Myers?
Well, Bristol Myers is of course trading at a very low PE, but this because they have a patent cliff in a few years, very much generating free cash flow. However, they have been outspending that lately with a lot of acquisitions. So the idea is that the acquisitions replenish the pipeline. We know that in pharma, it's not easy at the moment to buy cheap, let's say, items, cheap products for the pipeline. So it all has to play out. It's Bristol Myers is not, let's say, an easy sleep well at night stock if you think about the next 5 to 6 years. But yeah, I have some of it in my portfolio, full disclosure. But that would never be a tier 1 or a tier 2 position with the risk it carries.
Okay. And then just to round up a couple more, Brecht has asked, any Belgian stocks on your radar?
No, but I do, of course, like to read the Van de Velde annual report each year.
I kind of guess you'd say that. And then last one is Wildebeest. Do you like any direct lending BDCs?
No.
Just give two ticker symbols though. OSCL and MSDL.
I stay away from these kinds of businesses. They're too on the too hard pile, and direct lending and
risky. That's risky. I mean, you get well paid for it. The dividend yield, I haven't looked at these tickers, but I would assume it's quite high. I would expect 8 or 9% from these guys. But it's, as you said, the risk involved in that is quite high.
Look. Yeah, so we also got a few other questions from David Abraham, Babis Philippopoulos, and Javier Huerta, but they are referring to companies that we have not looked into. So RVRC Holdings, Spectris, PLC, and Vale. So we can't answer them in this podcast. Sorry for that, but we wouldn't like to answer on these kinds of companies if we never looked at it. I
did look at the dividend yields of those two companies. 13% 13.1% and 10%.
Yeah.
Just
Well, I don't judge a book by its cover when it comes to the yields. I only judge them by the industry they are operating in.
yeah, exactly. But you'd expect to be well paid for the type of risk you're taking with this
Yeah,
type of
true.
company. I think direct lending would be a difficult one. But listen, thanks to everyone for all your questions. Lots of interesting questions. I think the takeaway for me is Rubus. I think we want to look into that one a little bit more. It has definitely piqued my interest. So thanks to everyone for your questions. I got through this a little bit jet lagged. Thanks to European DJI for holding the fort. And we will see you all next week.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.